Welcome back. You're watching IndianOpen right here on Bloomberg Quint Live. And today, Neeraj, most likely is going to be a day where we open in the red, considering the global market setup is definitely not supportive.
Yeah, and no surprise there. This should start. I mean, frankly, no surprises there. The question mark only is will we worsen as the day goes by or not.
All right, as you can see up on your screens, Asia as a pocket is looking extremely weak. China particularly taking a heavy knock of 4.25%, followed by Hong Kong, which is down about 3.5%. Michael Priest, Executive Director of Client Investments at Taurus Wealth Advisors, is joining us on the phone line right now from New York. Michael, thanks very much for taking out the time.
Yes, good morning.
Clearly, some tweets and some comments with regards to further tariffs being raised on Chinese goods and imports, putting the equity markets in a tizzy at least.
Basically, I think this is a major shift in psychology because you think about it, since the December lows, the market has been rallying on two things. Number one was this idea that the Fed was pivoting and even might cut rates. And the second thing was that there will be a trade war solution. Right now, it looks like it's increasingly taking longer time. And also now the Trump administration is somehow getting frustrated and takes a tougher stance. And what I always felt expected, because there is no easy solution to this. So the market became very complacent. And what's interesting is from Mr. Trump's perspective that the tweet came out just after the market reached an all-time high. So maybe they're trying to engineer a correction as well in the stock market.
Also the slight bit of, confusion, because the markets up until now were living under the optimism that something meaningful would come out of the trade talks. And suddenly you have a tweet like this suggesting that by Friday, another $200 billion worth of Chinese good would attract tariffs of about 25%, talks of China, walking out of the talks. Why such divergent views coming in such a short duration of time?
Look, that's a good question, but it seems to me that some in the Trump administration got frustrated with the time it takes to go through all these rather complicated issues. And if you really think about it, there's no easy solution to all this. And China, of course, is also not willing to be too much under the control of the U.S. And ultimately, if you think about it, it's about technological leadership. So there's no easy solutions out of this. And Mr. Trump is now most probably trying some hard pressure negotiation tactics. I think what the market realizes that if this goes wrong, then we potentially could have meaningful downside ahead of us. And that's why I think we have such a strong market reaction this morning.
Michael, how do you think, it's difficult to, of course, predict this, but how do you think this shapes up? Because as I was looking at the data, the CBOE VIX, the short positions on CBOE VIX, on volatility as well, is probably at levels that we haven't seen in a while, despite the fact that VIX is so low. Do you think an event like this could bring about serious volatile repercussions on the short side for the markets? They may be short-lived, but could they be exaggerated?
It could be, also because don't forget the market went to an all-time record high again, right? And as you said, the VIX was extremely low, and hence so we could see this rubber band snatching back. Because if you think about it, over the last couple of weeks, whenever you looked at the market headlines, there was market rise for hope of trade talk, right? Trade talk truth. Now that it seems to be increasingly out that there is no hope, that the reality is this is much more difficult to fix, and hence the market most probably needs to adjust, yes.
Just wondering, again, I know it's difficult to predict, but would you expect, when we talk about an exaggerated reaction or possibilities of an exaggerated reaction, are we talking about a 4-5% move, or do you think it's difficult to call that?
Look, given the fact that the market went from extremely oversold to extremely overbought, I think we can potentially see even more of a decline, or a pullback rather, because if you think about it, in December, the market at one point fell for 20% and then had a major rebound for most of this year. So I think a healthy pullback is actually healthy and shouldn't be ruled out in my view.
All right, Michael, we'll leave it at that. Thank you so very much for joining us with your quick opinion out there. China, though, has already taken the brunt of it, and if you're talking about an exaggerated move, that's down 4.5% already.
And this is just day one.
This is just day one. And this could definitely mean a derailment of the excitement that, and the stability that was there up until now with regards to the trade talks, because there was no major gyrations in stock market prices in anticipation of the trade wars going south.
Yep.
But now that this has happened, it could definitely mean, I don't know how long this could last, but it would definitely have an impact.
No one knows. You're right. But yeah, I think just to sum this up, in my views at least, I think Michael made a very important point. Two big legs, rate dovishness and trade war resolution. Both of them looking wobbly. That's what we can watch.
All right, let's come back to our markets then. And have a look at what happened in the derivative space and what the setup for that looks like this morning. Agam Vakil is joining in with that. Agam, good morning.
Good morning, Devina. Well, it was a truncated week last week, and there was some sort of consolidation, which is why we really didn't see as much of a movement when it comes to change in open interest for the Nifty futures. The Bank Nifty futures, on the other hand, did see an addition of around 3%, but volatility is going to be of most importance today. We saw about near 5% increase there, and we're likely to see that increase given the global volatility. As far as your open interest is concerned, we did see changes around the 11,800 put, where there was a little more writing, and we're going to have to wait and watch whether or not those specific calls will start getting written today as well, given what we've seen. But in terms of stocks, we do have Jet Airways, which remains in focus, of course, which is new in the F&O ban, and among other stocks. We're watching out for Dewan Housing Finance, Torrent Pharma, Cipla, Britannia, all seeing a surge in open interest. In terms of unwinding, we're keeping an eye on something like an Ajanta Pharma, Container Corp, and Apollo Hospitals as well, besides Jet Airways, which has moved in the F&O ban. But most likely, it is going to be a volatile opening today.
All right, Agam, thanks very much for that. So we're definitely going to keep an eye out on all of those stocks that Agam highlighted. And aside from that, the two big numbers that come out today, Bharti Airtel, ahead of that, what happens, and ICICI Bank, another big one in the private banking space. Profit expectations, a bump up of 124% in profit. That should probably augur well, at least in terms of the sentiment ahead of numbers. I don't know whether they'll deliver on that or no. Considering that, this is a bank that's starting to focus more on the retail side, which could be the next big mover for private sector banks. Their corporate focus is moderating, retail focus is increasing.
Yeah, we need ICICI Bank to do well, especially after what Yes has done. So let's wait and watch what happens there.
Yeah, bringing in Avinash Gorakshakar, Head of Research at Joindre Capital Services. He's on the show with us. Avinash, good morning to you. Last week was a truncated week, no fireworks. The Nifty didn't do much. What's expected as we step into trade today and nonetheless over the medium term?
I think, Devina, clearly global headwinds are now far more important, and I think we could see possibly a gap down today. But I think clearly, if you look at the overall, performance of few companies in the last week, I think clearly some of the companies have done remarkably well. I think some of the smaller names like Federal Bank from the private banking space has come out with a very strong set of numbers. Asset quality has improved. The loan book growth has grown. I think within the specialty chemical companies, Deepak Nitrite has come out with a very strong set of numbers. The commentary is also very strong. I would believe that, the markets may definitely be a little down today considering the kind of global uncertainty. But I think probably at some point of time the markets would stabilize, and I think it's going to be again a stock-specific approach which is going to help investors. Our view is that these kind of dips, whenever they do occur, I think you need to bet on a few companies which can actually ride against the tide and actually deliver good returns over the longer term.
Two companies that we've spoken about already, Avinash. Let's start off with those, and then we'll talk about the federal banks and the others too. HUL. The number seems to be not bad.
Yeah.
Is that good enough?
I think, Neeraj, these numbers definitely are good enough. The key thing is 7 to 8% volume growth is something which the markets would be hopeful that this run rate is at least maintained, because the base effect is definitely very important. I would believe that, given the kind of challenging headwinds, Livre has delivered a pretty decent set of numbers. So I think if you compare the other companies like, say, a Godrej Consumer or maybe a Dabur, I think Livre has definitely done a far more better kind of, improvement on the volume front. And I think the markets would obviously definitely look at it more positively. I don't think there are going to be any negative surprises, considering the fact that in a challenging environment, Livre has delivered a decent set of numbers.
And for a behemoth that it is, I mean, to still maintain the run rate and clock in a 7% growth rate, I mean, that's commendable and maintaining margins, pushing up a bit, 13%.
Yeah. Which is why the not bad wording by a lot of brokerages too, I guess. But yeah, Devina's right. I mean, that is commendable. The other one, Avinash, and I know you track this well, you referred to it, Deepak Nitrite. We spoke about it just a while back, at least the numbers analysis. Is that good enough for a stock? Is it expensive? Is it cheap? Is it reasonable?
No, I think over the next 12 months, I think clearly the markets would obviously look at how operating leverage plays out, because already, the phenol plant which got commissioned in October is now operating at more than 100%. The acetone facility will now be the key driver. My sense is, I think in terms of earnings growth, one could definitely expect a very strong jump in earnings, both from a top line as well as on a bottom line perspective. And I think, Neeraj, any weakness today should be used as an opportunity. I think this is going to be a year where possibly volume growth and margin stability and plus the operating leverage would kick in. So even at these levels, I wouldn't be surprised that there could be some good value buying around 270 odd.
Okay, value buying at about 270 odd, Avinash Gorakshakar believes could happen. I reckon the answer is a bit tempered because of the market mood today, but it'll be interesting to see what happens during the course of the day. Avinash, stay on, so much more to talk about. Let's go across to our research team to talk about the key newsmakers of today. We've spoken about HUL, we've spoken about what is arguably the result of the day, which is Deepak Nitrite, but lots more happening beyond that. Stocks and news, Cadila, Infibeam, it's a packed house, and let's talk about all of these. What should I start off with? Mishika, I usually start off with stocks and news, so let's start off with those first.
Okay, so we're first looking at the important results. The first one is L&T Technology Services, which came out with a good set of numbers. Their dollar revenues are up 18% at $191 million. Revenues are up 27% at 1,343 crores. Net profit is up 21% at 192 crore rupees. And EBITDA is up 51% at 248 crore rupees. Their margins stand at 18.5% compared to 15.5% last year. Then we have Tata Chemicals, which also came in with average numbers. Their revenues are up 8% at 2,759 crores. Net profit is down 65% at 409 crore rupees. EBITDA is up 3.6% at 531 crores. And margins are at 19.2% compared to 20.1% last year. They had an exceptional gain of 1,267 crores in the base quarter. Then we have the Federal Bank result, which was above estimates. The net interest income is up 18% at 1,096 crore rupees. Net profit is up 163% at 382 crore rupees. Then net NPAs are at 1.5% compared to 1.7% quarter on quarter. And the gross NPAs are at 2.9% compared to 3.1% quarter on quarter. Then we have Indiabulls Housing Finance. Their board reverses scheme of amalgamation with Lakshmi Vilas Bank and proposes to merge Indiabulls Commercial Credit with Lakshmi Vilas Bank. The board has reaffirmed the exchange ratio for the merger. As for every one share held in Indiabulls Housing Finance, the shareholder will receive 7.14 equity shares of the bank. And lastly, we have Yes Bank. ICRA downgrades credit rating on various debt instruments of the bank, given the deterioration in credit profile of some of its large borrowers. And the downgrade also factors in further weakening in Yes Bank's core equity capital cushions because of the voluntary provisions and consequent losses in Q4 of FY19.
Well, that's an oops moment for Yes Bank. Let's see how it reacts. Thanks a lot for that, Mishika. Cadila, that could react too.
Yeah, so basically what happened was the US FDA and after Friday market hours came out with a notice on the exchange, and the company says that the US FDA has inspected the Moraiya facility and issued a Form 483 with the 14 observations. Now, basically, the observations are not known. 14 is a big number, so that is why it will react negatively. The company itself has said there are no repeat observations. There are no data integrity issues, but after 1 or 2 weeks, when the letter becomes public, that is when the reaction will come in terms of how this is. But expect the counter to react negatively today. It's already trading at 52-week low. Why is Moraiya important? Close to 50% of their US sales comes in from this plant itself. A lot of their pending, almost 35 out of the 100, pending ANDAs are from the US, from the Moraiya plant. And Moraiya was one of the only plants, which was clear, which got cleared and didn't have any adverse impact, and that is why the rally was seen over the past few years in Cadila Healthcare. But Moraiya plant troubles again. If that happens, that will be lead to big consensus downgrades for Cadila going ahead. Expect the counter to react negatively today.
So if it reacts, I think 10-11 rupees away from 4-year lows, if I'm not wrong.
Yeah, it is. It's trading at a 52-week low. It's almost down 50% from the recent lifetime high that it had, in June last year. So obviously that will, as you pointed out, 4-year low will be imminent right now.
Wow. Let's wait and watch what happens to Cadila today. Also, not as large a stock, but Infibeam, important because of the development.
Important, Neeraj, and a lot of question marks were there raised by a lot of brokerages. But the investors community is feeling slightly nervous as Infibeam board has recommended termination of services of SRBC and Company LLP as their statutory chartered accountants. This entity is an arm of Ernst & Young EY, which has been told to terminate its service for Infibeam as a statutory audit. Interestingly, the board has recommended the same because the board feels, for Infibeam that the statutory auditor, the arm of EY, has breached the contract by, sharing a lot of unpublished price-sensitive information regarding the company on multiple occasions. Of course, the allegations have been refuted by, the statutory auditors, which is SRBC and company, the arm of EY. And also the company has put an allegation that the unpublished price-sensitive information shared on multiple occasions has led to the breach of trust and loss of faith, because of which they have terminated the service of the auditor. And more importantly, they have intimated the stock exchanges that Shah and Taparia, which are the statutory auditors of the company, will continue to remain the statutory auditors. So there were earlier two firms which were doing the statutory audit. Now only one firm, which is Shah and Taparia, will continue to the statutory audit. As far as Ernst & Young, response is concerned, that is quite important because we have seen they are refusing to look at this allegation. In fact, they say that we strongly deny the allegations against us. We have conducted a comprehensive investigation and stand by our findings. We are confident of our position and open to third-party regulatory investigation, and we will respond to the regulators as required. So, as far as Ernst & Young and their entity is concerned, they have clearly refuted the allegations made by Infibeam.
No, not surprising. Let's wait and watch. I would presume that Infibeam would be the stock which will be nervous in the session today. Okay, so those are the stocks that could react. A couple of things that we'll watch out for today in terms of numbers that will come out. Shefali, I can start off with you. What's the big bank expected to do?
Well, ICICI Bank will report its earnings today, and the expectation is that they'll report a net interest income growth of about 20% and a huge jump in the profits, a growth of about 124% to about 2292 crore rupees. We are expecting the loan growth to be around 14%, primarily to be driven by the retail book, and deposits growth is expected to come in at about 13%, mainly driven by the term deposits. Other than that, we'll mainly watch out for how their asset quality pans out. The expectation is that they'll do very well in terms of the asset quality. All the incremental stress is likely to go down from this quarter on. Watch list loans are also expected to decline on a sequential basis. Their gross slippages are expected to moderate to about 2% Their IL&FS exposure, that is included in their BB and below rated book, so it's not likely to cause much volatility, and in any case it's a relatively lesser exposure that the bank has. The net stress loans as on Q3 stood at about 6.8%, so from that level it's expected to moderate. Margins expected to remain stable at about 3.4%. So that's one big set of numbers that we are looking forward to. And I'll take the liberty to add one more number to this. LIC Housing, which reported numbers on Saturday. So on the face of it, the numbers were very good, NII PAT above, but the internals look slightly fishy because their NPAs inched up, and their incremental lending to the developers, that went up. So that might see some negative reaction today.
Yeah, the market is not liked what 2 or 3 of these financial companies have done, which is increase the developer lending. If LIC Housing Finance has done that, let's wait and watch how it reacts. Thanks, Shefali, for that. Bharti, what's expected?
Well, it is expected to be a good quarter because there's some improvement that is expected in the India mobile business. However, on the consolidated basis, if we see, it is expected to be a flattish quarter compared to last quarter. The revenues are expected to come in at close to 20,600 crore rupees. EBITDA is expected to be close to 6,300 crore rupees. Margins are expected to marginally expand to 30.5%, while the company is expected to report a net loss of close to 1,000 crore rupees. Now, the key number for Bharti Airtel would be the average revenue per user. That is expected to come in at around 120 rupees per user. That is 15% higher compared to last quarter. Now the growth in ARPU will be because of the full quarter impact of the minimum recharge plan, which will lead to further subscriber losses. Along with that, higher 4G subscribers and fewer days in the fourth quarter would aid the company's ARPU in the fourth quarter of financial year 2019. Now for the India mobile business, if we see, growth is expected to primarily come back because of more data users and because of this minimum recharge plan that was initiated by the company in the third quarter of financial year 2019. Overall, the India mobile subscriber base is expected to decline to nearly 27.6 crore versus 28.4 crore reported by the company in the third quarter. However, if the fall in subscriber base is much higher, then optically the ARPU number would see some good growth, but if you see the overall numbers, that could still be weak because if the subscriber base falls further for the company. Now, one thing that needs to watch out for is the non-mobile business, and if you see for the broadband business and the fixed and the DTH business, now Q-on-Q the revenue is expected to decline because of competition and because of implementation of the TRI's new tariff order. On the consolidated basis, if you see, the numbers could well surprise and come ahead of the analyst estimates, but that would be because of the strong Africa performance that we have seen as against the analyst expectations. The Africa business reported a good growth. The EBITDA increased for the company when the analysts were expecting a decline because it was a seasonally weak quarter for the Africa business. Lastly, key things to watch out for from Airtel numbers would be the rate of 4G subscriber addition, the FY20 capex guidance, their asset monetization plans, and any commentary on tariff hikes would be important to watch out for.
Commentary on tariff hikes. I wonder if they can do that at this point of time. But Samit, thanks so much for putting that into perspective. So lots of stocks. Thank you all of you for joining in today and giving us those perspectives. Keep in mind, the Asian markets are behaving even worse now. If you just take a quick check as to what's happening, Hang Seng is down about 3.5. SGX Nifty is worsened. It's down about 90 points, and Shanghai is down about 168 points. So the world markets aren't looking a very happy place right now. But Avinash, lots of stocks that we discussed. If I had to pick one, Yes Bank, the downgrade that came in, or Cadilla, because of the observations that have come out?
I think clearly, if you look at the kind of damage which is going to be more severe is going to be on Yes Bank, Neeraj. Our sense is that this is going to make, a kind of a big challenge for Yes Bank in terms of fresh capital to be raised. Considering the fact that they have large exposure to the Adak group, and now this ICRA downgrade coming, we could see a little bit more of a continued sell-off here. I think whatever bounce we had seen in the stock earlier, obviously is not going to be sustainable, and I think we could see a lot more pain at least for the next 2 to 3 quarters. Cadilla, I think clearly also could possibly see some selling pressure, considering the fact that the numbers for the next 2 to 3 quarters could get impacted. But I think overall there have been some bright spots, as I mentioned, Federal Bank, Deepak Nitrite. These are stocks which could possibly see some value buying in these kind of markets. I think it would be a good opportunity to actually buy out these companies.
All right. Avinash, just stay on with us, get in more of your opinion, but also get in our technical experts right now. Manoj Vayalar, Associate Vice President for Equity Derivatives at Religare Securities, is joining us on the show. Along with him, Ruchit Jain, Technical Analyst at Angel Broking, is with us. Gentlemen, good morning to the both of you. Manoj, I'll start off with you. First off, on the index, last few days have been fairly lackluster, but today's session could see a big negative open. What would the trade look like then?
Good morning. Ideally, we look into a lot of consensus that happens in terms of positioning, which happens more into the index, which is your Nifty and your Bank Nifty. So for this contract of May, we have seen that roughly 26 odd lakh fresh long position has been created by the Nifty. For the Nifty rather, at levels of around 11,630. So we believe that the weighted average price of 11,600 would be the pivot in the downside, and somewhere close to 11,900 and possibly 12,000 also is very much possible. The reason is, as I was saying, we started with an open interest of around 1.9 odd crores, and there was a good surplus of that fresh longs that we saw in the Nifty. The last month, that is when we rolled from March to April, we had actually not seen that, and we all know that April was more or less a range bound session, and the participation was less even in the intraday charts or in intraday data. If you see, the net OI change was not more than a 3 to 5%. Now the only catch here is the Bank Nifty and Nifty. There is a ratio, a beautiful ratio which works between them, and we believe that the support is somewhere close to 2.49 or 2.5. Currently we are at 2.52 and the resistance is at 2.6. So we believe that in today's event, if we see follow-up buying which comes into the bank nifty, we expect the support to be at 29,900. The nifty might take charge once we see short covering, and that might happen beyond 11,830. So a simple strategy here is, as of now, the nifty has not given you ticks to go fresh long. If you get levels of 11,650, certainly that is a level to go long. But as of now, bank nifty buying at 29,900 to let's say 930 on the futures, stop loss 780. And again, the last trading sessions almost high of 30,200 is what we expect as a long trade, which can be done after the gap down opening today.
Okay, that's on the index. Ruchit, do you want to come in too on what could the apt strategy be to trade the index right now?
Definitely, it's been last 7 trading sessions we have seen markets trading in a very narrow range of 11,655 on the lower side and 11,800 on the higher side. So usually whenever we see such range bound trading action, a breakout is required to take any trade on the index, because the directional move comes in only post the breakout of that range bound session. So although today the SGX Nifty along with other in line with other Asian peers, it's showing a gap down opening, but still it is above its support of 11,650 followed by 11,550, which is the recent low. So I think we would still continue to trade in this range. Definitely the volatility is now expected to rise going ahead because of what we have seen in the global markets, as well as the elections outcome which will come in this May expiry. So I think the volatility would increase. If one has to take a trade on the index, then till the index continues to trade in this range of 11,550 to 11,800, buy on dips near 11,600 kind of range, so that the risk reward ratio would then become favorable, and keep a strict stop loss below 11,550.
All right, and you may get that opportunity today itself. Individual stocks then, which I'll keep it with you. You're liking DLF and you're looking at buying the 215 call option on Tata Motors.
So DLF has retraced about 61.8% of the previous up move, and during last week the stock had formed a bullish hammer pattern, which is a reversal pattern exactly at this support level. So this could lead to a positive momentum in short term. So definitely if you look at my stop loss, then the stop loss is a bit deeper from current levels. So one need to manage risk management properly. 166.40 is the support which should not be breached if the stock price has to go higher in short term. So this is a short term call for about 15-20 trading sessions. One can go long on dips today with stop below 166.40, expecting target around 198 in next 15 to 20 sessions. And Tata Motors, primarily because if we look at the historical data, levels around 200 were earlier acting as a resistance till March series. Then in April series we saw a breakout above 200 levels. In April series we saw a breakout above 200 levels where fresh long positions were created. Usually after such breakouts, whenever prices again show retracement, the earlier resistance converts into support. So 200 to 205 range is a very good support range, where also 200-day moving average is placed. To limit the risk in this, I am recommending to going long through options. So a 215 call could be bought, which was trading around 10 to 11 rupees, keeping stop loss below 4.40, expecting 20 rupees by the end of this monthly expiry.
Okay, those are some ideas, Tata Motors and DLF from Ruchit. Manoj has got a long list of ideas. We've got ITC, we've got Sun Pharma, we've got Arvind, and also a trade on the bank nifty, Manoj.
Right. Before that, I'd like to just put this thing. If I'm not mistaken, during the last central elections, the volatility index touched a high of somewhere close to a 24.2. But this time, we might see it go to a 32, 32.5. Now, the reason is not because we're being pessimistic in the market. The thing here is, since 11th of Feb, if we all know that the Nifty has introduced a weekly option. So once a weekly option comes into play, the volatility index, which is nothing but the swing that happens in the next 30 days, goes into a different calculation. So the VIX might pick up close to a 32 to 34, which is where we might see a lot of option writing happening. Now coming back to the stocks, we like ITC. ITC has got a positional target of 330, but as of now, for the trading level, we believe 300 is a good level. We can buy that. The stop loss should be 292, and the first target comes at 316. So 316 is where we believe there would be some profit booking. So the first trade comes in that. Sun Pharma is interesting because I guess the stock has not really done, or maybe has seen a lot of distribution, let's say last 3 months. But off lately, this 440 to 460 level, we are seek some distribution which has been conversely gone into a short arbitrage. What happens is then you see the short covering coming from the stock futures, and ultimately that culminates into a cash based buying. So we recommend buying Sun Pharma, let's say at 452, that's a good level, we can buy that. There should be a strict stop loss on that because we are looking in for the short arbitrage to unwind their position. So 430 at the stop loss, and we're expecting a surge always till almost till 475 to 480. That should be the first target. Arvind, interestingly, more or less the stock has been in a range, but we believe that there is a good potential, at least in terms of cash-based buying that has happened, and we might see possible in the follow-up trade. We are expecting there might be a possibility that if the banking stock sustains today, the second half of the market might try to come back to the positive terrain. So we are expecting stocks like these to help the index inch more. So Arvind is again a buy. We would recommend buying it in the cash market rather than the F&O market. Buy it close to 81 odd rupees. Keep a stop loss of 79 to 79.5, and the initial target should be close to 84 on that.
Okay, got that. Manoj, thanks for those ideas. Time now to move on to a special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock on your radar today?
Morning, Devina. So we are tracking Ultratech Cements on the charts, and there's a sell signal coming in, more in line with the theme today, and we are seeing the formation of a bearish engulfing pattern on the charts. Before we go ahead, let's first try and understand what the bearish engulfing pattern is. It is the formation of a red candle right after a green candle, wherein the body of the second candle, which is the red candle, would be larger than that of the candle ahead of it, completely engulfing it. The longer is the size of the second body, the higher is the evidence of a top forming, with no further confirmation needed there. Coming back to Ultratech Cement, we saw a big move over the last few trading sessions after the company came out with extremely good set of numbers. But post that, what we saw last week is that there has been some amount of correction or profit taking at the higher levels. We've seen it fall for the last two trading sessions as well. There was a doji pattern kind of a formation, after which we saw the stock fall by about 1.5% yesterday, with long unwindings seen as far as the May series data is concerned. Also, the fact is that the stock has managed to go into the uncharted territory after moving above the 4,500 mark, and the RSI 2 on the longer term time frame that has suggested an overbought signal on the stock. So pressure seems to be there as far as the daily charts are concerned, but the trend would turn negative as well on the longer term time frames, be it the weekly chart as well. So watch out for Ultratech Cement, given the kind of setup that we are in. It should see some big amount of movement on the downside.
How well has this worked in the past though?
So Devina, 7 out of the last 11 times that this has managed to happen over the last 1 year, the stock has managed to fall on an average close to 4.5% over the next 1 month.
Okay, thanks a lot for that, Yash. So watch out for Ultratech 2 showing this pattern, and with the market looking slightly wobbly, this could well work. By the way, the SGX Nifty is now down 84 points. It's now trading at the lowest point of the day. Keep that at the back of your mind. Avinash, cement, now, could this be a market-led move, or would you believe that because of the results that have come out, any downsides could be contained? Birla Corp, I thought, came out with numbers which were interesting. Orient Cement, we've already seen that. What have you made of some of these?
No, I think cement as a pack, I think should do well. I think the larger players like Ultratech and even south-based companies like Ramco Cement, Birla Corp, which operates largely in the eastern markets, I think should definitely do well. I think pricing gains and volume expansion, and obviously the benefit of operating leverage is going to benefit these players. Our sense is that FY20 Neeraj could be a lot better for larger cement companies and niche players like Birla Corp, which have got a large hold in the eastern India market and where prices have been quite remunerative. So I think any dips should be used to actually look at these companies, considering that earnings growth as well as top line expansion in the coming year is going to be pretty strong for most of these cement companies.
But the remotest of chances, if you've looked at Infibeam at all in the recent past, and this auditor issue that has cropped up again?
No, in fact, Neeraj, we have not have a active coverage on the stock, but I think clearly whenever such issues come in, the first point of concern is the kind of reporting quality on the numbers which have been put out in the past, because I think clearly the market respects numbers quite significantly, and any issue of this sort is going to be looked upon with a very, very suspicious kind of move from the markets. I don't think a new auditor could take a lot of time to actually reinstill confidence, and I think this stock has been put out of F&O. Earlier it was an F&O stock. So I think clearly these are typical stocks where it's very difficult to believe the numbers and the management commentary, despite the fact that we could get some clarifications even post this development.
Yeah, so maybe, but out of FNO, so not too much of interest as well. I don't know how many people really, except for a pocket in Ahmedabad, might be owning Infibeam as well in the first place. Yeah, maybe a stock that's not quite top consideration right now. Ruchit, a quick thought on what do the charts for a Britannia or a Dabur or a Godrej Consumer indicate? If they start off slightly lower, could there be more downside here? Any one of these, don't give a comment on all three, any one of these which looks the weakest?
I think if I do some comparative analysis of these three, then Godrej Consumer seems to be the weakest amongst the three. Although we have seen some recovery from the lower end on Friday, but if I look at some of the historical data, then this has been one of the underperformer amongst all three, Dabur, Britannia as well as Godrej Consumer. So in short term, we expect the stock to correct further towards 594, 595, which is the weekly 200 moving average. So at current levels, if we see a bit weaker opening, then one can create short positions in Godrej Consumer, keeping stop loss above 658. We're expecting target somewhere around its weekly 200 average, which is 590.
All right, 33 seconds left to go for market pre-open, and it doesn't look like it's going to be a great start, as pointed out by the SGX Nifty and the rest of Asia, which is looking extremely weak. Shanghai is now down about 5%, with the Hang Seng trading lower by 3 1/3%. SGX Nifty itself is down about 80 odd points. You should be able to see some moves coming in on the back of what happened on Friday, particularly after HUL ahead of numbers was down 1.7%. You could actually see a positive reaction in HUL at pre-open, and the stock reacting to those numbers, which were not so bad. That's a pre-open session for you on the Nifty. We're down about 0.5%, still waiting to get those ticks going on the Sensex. But we'll take you through the individual stocks and the individual movers and come back to the index in just a few moments. So starting off with the big losers in trade. You've got heavy cuts, obviously, and this will all start to cool off. But just running you through a Yes Bank, which is down 4.5% right now. ICRA has downgraded its long-term instruments, and the stock is reacting to that. Hindalco Vedanta, so metals as a pocket is looking weak. IT as a pocket was weak in Friday's session, and that continues to remain weak in today's session, with TCS, which was the worst performer in Friday's session, now down 1.3% in pre-open. Tech Mahindra follows it, down 1.2%. Infosys is the next one. Tata Motors also looks weak. You've got Sun Pharma, Grasim, and Indiabulls. Housing, though, is showing you a 10% cut this morning, but that should cool off. Let's take a look at what's happening with an HUL post the numbers and post the markets being able to digest the numbers, and likely so after that 1.7% cut in Friday's session ahead of numbers. The stock with not so bad numbers, flat to marginally positive. But let's see how the open shapes up for it. Other stocks then on the index, which are looking slightly more weak from the banking space, should pull up an ICICI Bank ahead of its numbers, and what it's doing remains unchanged for now. But that's what you've got in terms of the Nifty open.
The rupee was strong last week, gained about 1%. Let's see what it's doing this morning. Slightly weak, 69.40. And the bond yields should come up on your screen as well, 7.39, pretty much status quo. Just 2 or 3 names because the rates take a time to settle down, so one will spend too much time here. Deepak Nitrite, Federal Bank, as well as Aditya Birla Capital, 2 or 3 names. Deepak Nitrite, marginally higher, very strong set of numbers. On a day like this, starting off okay. Federal Bank, likely to start off okay. Let's wait and watch. And lastly, Aditya Birla Capital, strong numbers, likely to start off positively. Jet Airways, remember, starts off slightly weak. At least the pre-open rates seem to suggest that. But take it to Federal Bank, Avinash. You spoke briefly about it when we started off the show. What did you make of the numbers? The asset quality has been a big bugbear for Federal Bank. And this quarter, at least, it's shown some signs of cooling off. Improvement, I mean.
Yeah, I think, Neeraj, in the management commentary and the con call, I think one thing was very clear that the management is now very confident that asset quality could possibly further improve. And I think on the ROA side, they are pretty confident that from 0.95%, they could look at ROA of almost 1.2, 1.25%. That clearly means that they could be looking at better operational numbers. And I think clearly in terms of the loan book growth, the SME segment, corporate segment, retail segment, all have definitely remarkably grown. our sense is that asset quality has been a kind of a problem for the bank for the last 5 to 6 quarters, and this has been a welcome change. I would believe that the markets would definitely look at this positively, and hopefully we have a kind of gradual improvement in NPAs. You could probably see a further re-rating in the stock.
Let's wait and watch if that happens. But yeah, certainly good numbers. I think the mid-sized banks have done some pretty good things. I mean, save for Yes Bank, most banks have done that, but the mid-sized banks, so Federal Bank is one, DCB, and I remember talking to Avinash only about that. It hit some life highs or 212, 213 back then when we had that conversation. So that one came out with good numbers too. Somehow these companies are starting to show some promise.
Bandhan
Bank, well, 67,000 crores of market cap, and that one had a fabulous move too. By the way, actually, speaking of Bandhan Bank, Avinash, just a quick thought out here.
No, I think the best part about Bandhan Bank, Neeraj, is that net interest margins and their ROEs have been really very, very strong. And I think looking at the fact that now, with the proposed merger of Group Finance, I would believe that, they get a very quality housing finance portfolio. So I think, I would believe that, this is a clear case of very strong kind of management and a very strong kind of growth trajectory. So I think clearly any dip post the numbers should be used as an opportunity to actually look at accumulating the stock. I would not be surprised that FY20 should be a lot better and a much stronger year.
Manoj, within the smaller banking pocket, would you initiate a buy on any of them, likes of Federal, DCB, Bandhan?
Well, we work a lot on the quantitative analysis, and we believe that the PSU banks can outperform, but then that happens on a quarter basis. If it is purely for this month of May, I believe ICICI is still the top bet, but try to buy it at the weighted average price of 396 or 398. That is a good price where the stock can give you a rebound, and the rebound can be close to 414 to 418. So buying ICICI Bank close to 396 to 398, keep a stop loss of 8 to 10 rupees on downside, and the projected target should be 416 to 418 is what we would still vouch for.
I wonder what would and Manoj, that's my final question to you, but Devin, I wonder what will the repercussions be of what Donald Trump has tweeted yesterday on some of the global stocks, the commodity names, etc. Would all of them be under pressure for this particular reason, that if the trade talks go off, then global demand cools off, or crude cools off, yes, but some of the commodity names, the metal names, etc. might also face some problems.
Yeah, because you're talking about the economic engine and whether or not that can spur enough demand to keep prices afloat for some of these crucial commodities.
Yeah.
If that doesn't happen, then obviously like what we're seeing in metals today could be a reality for some of the bigger names as well.
Yeah, maybe too soon to call, but because of the fact that they moved up, could there be a pullback? That's the question. Manoj, before we let you go, the metal names today, Tata Steel, JSW Steel, or even the base metals, the Hindalcos of the world, is there a trade that you foresee on any of these?
Well, if you see, metals had shown good shine. That was when we rolled from the March to April series. Now, ideally what happens, we look into the sectors which are responsible for the Nifty to gain, at least in terms of levels which happen. So, metals have not really shown their participation, at least on this rollover from April to May. It was more into, as I said, more into the banking and as a sector which will have to outperform so that the Nifty goes up. So metals, as of now, we should wait, and most important, we are in this range of 11,600 to 11,800. A breach of that, is going to be quite crucial, because if you see the FIR chart which is panning up in the last 4 to 5 sessions, what they're doing is a 1:2 ratio of an index future sell to an option buy is what we're seeing. So let's say a net cumulative 11,830 odd weighted average price of some short positions they have, and 11,630 is good amount of long positions we have. So it's a battle going on in this 200 odd points. A breach of either these levels takes us to almost 11,300 and a good 12,000 odd level. So we should wait for this, because the next 300 points below the breach or the surge of these two levels is going to be quite let's say we can tame that into a trading. So we should not get into a hurry right now. Closing below 11,600, I guess 11,300 is on the cards, and if we breach that 840 odd levels in the Nifty, 12,000 certainly on the card. So we should wait for that to not get into metal stock at this point of time. As I said, there are banking counters which the weighted average price of rollovers is going on. So wait for those levels to come in, only then you take a long position. We should not rush to get into long positions, at least in the stock based futures buying, because the M2M costs you more, that generally happens. And towards the weekly expiry, we would see the levels not really going or crossing beyond the weighted average price. So I would say refrain on that.
All right, Manoj, we leave it at that. Thank you so very much for joining us this morning. Ruchit, I want to come to you. When we spoke about an Ultratech Cement showing some signs of weakness after that big jump post its results, do you also anticipate further downside on an Ultratech Cement?
I think there could be a pullback move within this uptrend, but there are no signs of trend reversal, because if you look on the day of when the quarterly results were announced, the stock prices had given a breakout above 4,300, and that was supported by very good volumes. The long positions that were formed even in the derivative segment are still intact. So I think, and even if you compare Ultratech Cement with some of the large cap names within the cement space, then this stock has shown a good relative strength and has been an outperformer. So along with the markets, since markets are showing some negativity, so I think there could be just a pullback, but there are no signs of reversal of any trend. There are earlier resistance of around 4,300 or 4,400. If this range come, then I would suggest to go longs, and a buy and dip should be the strategy for this stock.
Okay, that's an Ultratech Cement. They're at 4,500 pre-open, down about 1.5%. The other one, Avinash, is Bharti Airtel. That's going to report its numbers today. Bharti Infratel, the disappointing numbers because of the lower tenancies, and the stock was duly punished once it's reported its numbers. But what is expected from the likes of a Bharti Airtel, particularly, and also, when we're looking at the entire industry as a whole?
No, I think clearly, the kind of pricing pressure which was there on ARPUs could possibly be a little less in this quarter and going forward, considering that, most of the players have realized that beyond a particular level, it does not make any economic sense to further cut down ARPUs. As far as Bharti Airtel is concerned, I think they could definitely benefit, from the proposed rights issue. I think that would deleverage the balance sheet to a smaller extent. But I think what kind of asset monetization happens to deleverage the balance sheet, getting out of non-core assets, and most importantly, the kind of growth in the subsidiaries, especially African business, I think would be key points to watch. Overall, the markets are not expecting any big positive surprises, except for the fact that operational performance on the EBITDA level could be a lot better. And obviously, once the rights issue money comes in, we could see a better kind of overall net profit, the PBT kind of number. Despite the fact that I won't be surprised that at least for the next 1 or 2 quarters, it's not going to be an easy road for Bharti. I think the markets are clearly aware of that. And probably you could see, some sort of consolidation on the stock. I would not expect the stock to run away. But yes, on the downside also, not much downside could come in.
Keep in mind, there could be another announcement along with the results, as PR Sanjay was saying, and we'll talk about that. And keep in mind, Vodafone Idea is starting on the pre-open session as the top gainer on the Nifty 500, up about 6%. Telecom certainly in focus today. But minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. First up, HUL's volume growth fell to its lowest in 6 quarters as rural demand moderated. Otherwise, the March quarter earnings were largely in line with analysts' estimates. The stock likely to be flat.
In earnings today, ICICI Bank's profits may jump 1.2 times in the 4th quarter on a year-on-year basis. Asset quality is likely to improve as well.
But Bharti Airtel may report a loss. The company's average revenue per user may improve, while its non-mobile business is likely to be a drag.
Infibeam terminates contract with its auditor SRBC & Co. on grounds of sharing unpublished price-sensitive information.
ICRA downgrades Yes Bank's credit rating on various debt instruments. The downgrade follows deterioration in credit profile of some of Yes Bank's big borrowers.
Lastly, Cadila Healthcare's formulations facility in Moraiya has received 14 observations from the US FDA. The plant contributes nearly 50% to the total US sales.
Okay. Two big drags, two big movers in the session on the morning. Avinash, before we thank you, I know I asked this question to you earlier, but now that the stocks have reacted, Cadila Healthcare, Yes Bank, downgrade and the observations, which one do you think has more downsides to itself currently?
I think obviously Yes Bank, considering the fact that I think clearly the markets are expecting that asset quality stress, Neeraj, could possibly get a little more painful in the coming 1 or 2 quarters. It may not happen that this asset quality issue may get resolved very soon. As far as Cadila is concerned, I think obviously the stock would react negatively, but from a medium term and a short term perspective, I think the markets would be clearly worried about Yes Bank, considering that asset quality stress is not going to go away in a hurry.
Avinash, we'll leave it at that. Thank you so much for taking the time out and being with us this morning and giving us those thoughts. Avinash, Gorakshakar with a slew of opinion on some of these names which could react negatively today. Not too many positive reactions, I'm afraid, that are coming up. Okay, in moments from now, of course, we'll get in Ashwini Agarwal, founder and partner at Ashmore Investment Management India as well. He'll be joining us on the show to talk about his thoughts. Okay, I'm told he's there. Ashwini, thanks so much for joining in. Very close to market open. Just a quick succinct view first before we get into the detailed view. Neeraj here, good morning. Would you believe that there is more downside, or could this be a flash in the pan move?
Neeraj, obviously the markets had a very good run over the last couple of months. And we have the election results ahead of us. So I think, the market is paying less attention to fundamental news right now, more focusing on the election outcome. So my sense is that obviously the fundamental news, as you pointed out, is not as energizing as we might have hoped for a variety of reasons. But overall, I don't expect a very big move in the market till at least the election results are behind us.
All right. We'll come back to you, Ashwini, because we need to really chat with you in detail about your views on individual sectors and pockets. But we're just very close to market opening. I want to quickly get a top technical trading idea from Ruchit on the technical side. One stock, Ruchit, that you'll be going with this morning.
I think just from a day perspective, one can look to create short positions in Wockhardt Limited. The stock has recently breached its short-term support of 413 during last week, and today it is again indicating another gap down opening. So we could see some follow-up selling or in Wockhardt. So with stop loss placed above 405 for intraday, one can go short on Wockhardt, expecting target around 386, 387.
Ruchit, quick 10-second call. Nifty 106 points lower. Would you initiate a short?
No, short should be initiated only if we see a breakdown below 11,550, because this is the support level which has not been breached since 20th of April.
Okay. Ruchit, we'll leave it at that. Thanks much for taking the time out and being with us today and giving us your thoughts. 11,550, that's been the sacrosanct level, to be honest, for the Nifty. The last two series, let's wait and watch if we hold on to that or no. But the market's starting off in a weak fashion. 112 points down now, 11,597. So sub 11,600 on open. Let's see if this worsens. The Sensex, 414 points. The Nifty Bank, about 375 points. These rates shouldn't bother people too much because Asia is a lot more worse off, though China has a direct impact and therefore those markets would react more. But yeah, we are certainly correcting. And now the Nifty Bank, 413 points lower. I think these rates are just an indication of what could happen during the course of the day as well. I would reckon that the broader markets too would have started off wobbly. At least the mid caps down about 1%. The small caps react with a bit of a lag, but 0.5% already. Bring up the heat map. I doubt there will be too much green. Let's see if there is any. Hardly anything. Power Grid, BPCL, iShares, hardly anything to talk about. Let's see the losers. Awash with red, by the way, the Nifty 50. Commodity names starting off wobbly, you wouldn't be surprised. Tata Motors starting off weak, should be surprised. Yes Bank 3.5% lower. By the way, what's also could be hurting is HDFC Bank, Infosys, the heavyweights, Reliance Industries, all starting off weak as well. So across the board, there is weakness. There is no carnage, by the way, except for the commodity names which are looking very, very weak. Otherwise, there's no carnage or bloodbath, to be honest. This is something that you would have anticipated when Donald Trump's tweets came out yesterday. So this panning out as per plan as of now. Let's wait and watch what happens during the course of the day. But the Nifty largely dominated by what's happening to banks as well as commodity names. Just a couple of other pockets that I want to highlight. HUL is not reacted too much. What about some of the others in the consumption pocket? Slowing consumption impact, not too much. Britannia starts off about 1% lower, but Dabur and Godrej Consumer fairly sedate, less than 1% down for these names. What about some of the companies that have come out with stronger results on a day like this? Are they reacting positively? Federal Bank about 1%, AB Capital about a couple of percentage points, Deepak Nitrite 2%. So the market mood playing in on these names as well. On an otherwise day, you could have had a fairly stronger reaction to these names, but starting off positively, which is not a bad sign. Devina, what are you spotting?
Airways for one is down about 5.5% in early morning trade at 128. Following that, you've got the likes of Diwan Housing Finance looking weak by 3.5%. McLeod Russell, remember the stock, it's seen a heavy cut last week. I think almost 40% last week itself. So that stock once again looking slightly wobbly. Infibeam, now that they have fired their auditors, down about 3.5%. LIC Housing Finance reported numbers, but like Shefali highlighted, their increase in developer loans is something that could raise question marks, and that's exactly probably what's happened with regards to the concerns, because the top line and the bottom line numbers were fairly okay. The Buildcon was down about 3.5%. SAIL is down in line with what the rest of the metals pack has been doing. So that's what you've got in terms of some of your top losers. In some of your top gainers, Lakshmi Vilas Bank, that's up 2.5%. Federal Bank on numbers is up 2%. You've got Vodafone Idea, that stock has gained some ground. Godrej Consumer, interestingly, is moved into the green now despite a disappointing quarter. You've got a Birla Corp, 1% higher. JM Financials moves up as well. And you've got the rest. HPCL also in line with what BP and IOC are doing, is doing okay for itself, about 0.5%. Nonetheless, 1:4 in the market breadth in favor of the decline. So it is definitely a weaker open and a weaker a broader market.
Well, Ashwini Agarwal is still with us. Ashwini, just wanting to get your sense of how you are approaching the event, and I think every Donald Trump tweet becomes an event, or some of his tweets become an event. How will you approach what the change in stance? A guest earlier who had come was saying, and maybe rightfully so, that from the December lows, the US markets have rallied on twin assumptions that the Fed would be a lot more dovish and the trade war will reach a resolution. If anything, the Fed has not sounded a lot more dovish in the last comment compared to what the market was anticipating. And the trade war resolution now seems to be on slightly shaky ground. Is it too soon to think like that? Or are you thinking like that? And therefore, your market prediction for the near term would be predicated on that assumption?
So interesting question. First of all, I think it's too early to read into these comments, because while the US Fed comments weren't as dovish as one might have expected, the fact is that there is no growth and there is not much inflation either. So one has to expect a softer policy rate outlook on a pure fundamental basis, the comments notwithstanding. And I think this whole tango between the US and Chinese policymakers on protectionism and trade, I think this will carry on for some time, but it is in the interest of both economies to find a way forward. So I remain optimistic on that front. I think insofar as India is concerned, I think the events that will drive India essentially are the outcome on the 23rd of May in terms of politics. And the second is, in the opening rates, as you mentioned, a lot of the NBFCs are down. I think what happens towards resolution of the liquidity with the NBFCs is, I think, very critical to the outlook of the broader market, because this is an area where there is an acute amount of distress, and it has to unfold properly without affecting the industrial sector in a big way. Because if this stress doesn't go away, then over a period of time, this stress will filter through to the manufacturing economy, to the consumer economy, and I think that could be bad news for India. So I think those are the two events that I'm a little more worried about, more than the global cues at this point in time.
But nonetheless, it is an important factor that's weighing in on market sentiment currently. Do you see the earnings backseat that we're seeing right now as being the double whammy for the Indian equity markets that could probably slow investment decisions for investors?
So, Divya, earnings season is still kind of unfolding. So we are seeing softer earnings reports from the consumer companies. Some of the autos are still to report, but at the same time, we are hopeful to see very strong earnings growth from the banks. And I think there are a whole host of other companies which are doing much better than what they have done over the last 3 years. So I remain quite optimistic that for the year as a whole, March 2020, we will see earnings growth which is much better than what we've seen over the last 3 or 4 years. I think the critical element for the outlook for the market also will be what happens to rates in India. Will the RBI take the call to cut rates aggressively in light of the liquidity requirement of the economy and the need to stoke consumer demand or not. I think that to me is equally important as earnings are. Like you pointed out, that earnings are soft in a few pockets, and we hope to see that they start normalizing over the next quarter or two. For that, return of liquidity to the market is very, very essential to the money markets, that is.
The reason why I ask you this question also is because these pockets that we're talking about has eroded a lot of investor wealth if you have it in your portfolio. While the index is still okay, you're not seeing a very large reaction to the index itself. It's around 11,600, which is not a bad level to be at. But individual stocks have really washed out portfolios. And right now, if someone has to think of fresh deployments, how does one go about that?
So, you have to look at least this is our belief, that you have to look at valuations, you have to look at earnings growth prospects and do bottom-up investing. I mean, the indices, are a great indicator, of course, but they hide as much as they reveal, because there's a great amount of dispersion of valuations as well as earnings within the index components. So, for example, let's take the consumer companies. The consumer companies have done exceedingly well over the last 5 years or so, very stable earnings growth in an environment where earnings growth was missing, which has led to valuations trading at levels that we have never seen in the history of some of these stocks. At the same time, you've had the banks which have gone through a massive grind in terms of the NPL cleaning up, and I think that is more or less over now. So my sense is that we will see much stronger earnings growth from the banks, and that's where there might still be an opportunity, despite some of the banks having done very well over the last 1 year, and some banks still facing some issues, which I think one has to be patient and see whether the resolution plans which are in place will work out or not. I think the key element that I would look for while investing in these markets is that, do you have valuation support or not? I mean, we are value investors, and therefore that's what we've always focused on, that are we paying a reasonable price for the earnings that we are buying? And there are pockets where that opportunity still exists. So I'm not that pessimistic right now. I mean, markets have had a run. I agree with you on that, and I think there are risks which are on the horizon. So let's see how these risks unfold before making a very large pronouncement of a leg down or a leg up.
Which brings me to my other point, since we're talking about the index and the components of the index, do you think that since financials, obviously we know that financials holds the bulk of the weightage on the index, about 37-39% in the index, and now that we've got one of the key exchanges talking about probably looking at capping sectoral weightages on the index to give it a better balance, I mean, what's your view on that?
Well, it does sort of the index methodology, if you study it, does merit from time to time interventions of the nature that are being suggested. I don't have a very good view one way or another whether there should be sectoral caps or not. I think some forced diversification, especially for ETFs, will probably happen if the sectoral caps are put into place, which I suppose is good in the longer run. But at the end of the day, financials do make up a large part of the economy, and services is a growing piece of the economy. So, my view is that the index makers and the regulators should also think about, does the index reflect the nature of the economy or not? And before we sort of cap financials, or we cap, any other sector, energy or oil and gas or whatever it is, my sense is that one has to look at, does the company or does the industry reflect the nature of the economy? And I think so long as that is not getting exaggerated, we should be okay.
Ashwini, just wondering, what should the approach be? Now, I take on board your point that banks in all likelihood will deliver good numbers. I would presume that that was something that almost everybody had baked in, that corporate-facing banks will come out with good numbers. Oh, I agree. What was also baked in was autos faltering. I don't think too many people anticipated the nature of the numbers that some of the consumer companies are coming out with. If that is indeed the order of the day, if we're hitting the home stretch of the elections and therefore volatility likely to inch up, and if the global market cues as of now point towards some bit of derailment of what was the hypothesis earlier, is it better to be in the risk-off mode right now, anticipating what could come in? Or you would be comfortable putting fresh money to work right now as well, despite the factors that I just spoke about?
Well, let's think about what happens over the next 6 weeks or so. First, you have the election outcome. It's clear that the market is pricing in a BJP victory, right? So purely from an odds perspective, if there is a small probability outcome that the BJP doesn't actually make the government at the outset and has to cobble together a coalition, or even a smaller probability outcome that the BJP is not in a position to even cobble together a coalition and somebody else has to do the job and form the government. In that case, obviously, there will be a massive risk off. So purely from an expectations outcome, when you have the BJP win priced in and you don't have a BJP loss or a difficulty for the BJP priced in, that calls for a little bit of a caution in terms of the outcome for the event on 23rd of May. The second part, which I spoke about earlier as well, rather than the global cues, I would focus a lot more on what happens to liquidity, what happens to the NBFCs, what happens to interest rates. One of the big problems that India has faced over the last couple of years is very, very high real rates. And that has been caused by a variety of factors. But I think let's forget about what happened. Let's look forward. I think what's required is a very steep cut in rates by the Reserve Bank of India, not in baby steps of 25 basis points, but something like 50, 75 or even 100 basis point cut. What is also required is a massive infusion of liquidity in the market. Otherwise, this whole NBFC issue will spiral into a bigger problem for the core economy, which we don't really want at this point in time. The regulator or the RBI in this instance is probably looking at the banks and saying, look, the banks seem to be in a fine shape. It's the NBFC sector which is facing a little bit of a problem. So do we really need to step in? And my worry is that if we just look at the banks and not look at the NBFCs, we might unwittingly expose the economy to a great degree of pain because of the larger size of NBFCs over the last 3 years. So, those are the things that I worry about. So you asked me whether I would put on a new trade today or would I put new money to work today. I think that is a question that each individual investor has to answer based on how he or she is positioned. Are you totally invested? Are you underweight equities? Are you a bottom-up investor and you're finding opportunities that make sense for you? So my philosophy is that allocation to equities is something which is very important, especially for individual investors, and that should be within a range basis the age and the income level that you have. And you can toy around within that range, probably be towards the lower end of the range at this point in time, if that's the answer you're looking for. But at the same time, I don't believe in making significant market calls and changing allocations drastically. So we as investors, as professional investors, prefer to stay nearly fully invested at all times. And we can continuously look for opportunities that the market offers. So that's and when we continue to find them. So that's how we are thinking about things.
Great. Appreciate you taking the time out today and sharing these thoughts, Ashwini. Pleasure speaking to you today.
You're welcome. Thank you.
Well, that's the view from Ashmore Investment Advisors, staying invested currently, not getting too bothered by the noise right now, which is also okay. The Indian markets are taking it well. But the world markets are not necessarily doing that, and that's what we do. Talk about the world markets. They faltered after Donald Trump threatened China with steeper tariffs. We speak to Seth Freeman of GlassRatner Advisory and what he makes of it, and decode the March quarter earnings with Vinay of LIC Housing Finance and Sudhir Singh of NIIT Technologies.
anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Welcome back. You're watching Indian Open. Donald Trump sat it again. The US president took to Twitter to make it clear that he's unhappy with the pace of talks being held with China and in turn threatened to hike tariff on Chinese imports into the US, and that's left investors worried, with all equity markets trading with cuts of at least 1% or more. Joining us now to talk about the situation in greater detail is Seth Freeman, Senior Managing Director at GlassRatner Advisory. Seth, thanks very much for taking out the time. This is just, one tweet that the president has put out that has done this to global equity markets. What, according to you, if at all, he's put out the day of Friday, we do see these $200 billion worth of imports from China getting a tariff hike of about 25%. What could be the full blowout implication of that?
Well, I think we're seeing the implication and how it can roil markets and futures looking, U.S. stock futures looking down for tomorrow morning. For us here, we're looking at the impact on currencies. It's somewhat confusing to make these threats now when there was a meeting coming in Washington very shortly. And, perhaps he feels very buoyant and confident after seeing such strong economic news here in the United States that he feels a little bit more emboldened to, add some risk to the economy with these kinds of threats.
What does this do now to the overall, growth numbers and the projections that have been made with regards to global growth? We know that the most recent China economic data, or the GDP numbers, wasn't a bad number. We saw the markets take that well. But do you see, repercussions of this having a deeper seated impact on the overall growth?
Well, the so-called trade war was partly blamed for what looks like a trend of slower growth, globally, both the United States and other countries and China. The issue is that China is a strong country now, and it has the means to retaliate against the U.S. for added tariffs. China just recently put back in quite a large amount of additional soybean imports, which is very important to the United States agricultural economy. And so China has plenty of tools to respond. And, they also have internal political concerns as well in dealing with these tariff issues and the need to appear to be strong domestically, which, according to the news reports, might mean canceling the summit.
Yeah, I think that's come out. Seth, a couple of pointed questions. One is, what does this do to the commodities universe? Do you reckon that there could be weakness and until the resolution of this comes about?
Well, of course, because slower growth would put downward pressure on commodities. We were seeing a general rise in copper prices, and copper is such an important component of manufacturing across the board. And this should, hurt base metals, copper, other manufacturing imports. It's important to realize that not all categories of goods were subject to tariffs, anti-China tariffs back in last year. And then there was the so-called truce in December. The kinds of products that would be within this new $250 billion threat includes things that U.S. consumers love, like cell phones and electronic gadgets. And this could have some backlash with consumers.
Okay. Said the other thing, when this whole trade war started, a lot of global guests were saying that India might actually benefit as a market and as an economy if indeed this happens, because it is in a sweet spot, doesn't get impacted too much, etc., etc. What happens in the period if this indeed snowballs into something bigger for the Indian markets?
Well, I think in general, the sentiment towards India is positive, and that has, frankly, less to do with India, and as you've touched on, more to do with negative China sentiment. The problem is that to date, India is really not a big net exporter. The government has done a good job, I think, promoting this idea of made in India. And, we have delegations here. I would say that the Indian government ministries are fairly aggressive in having road shows and coming to the United States to try to support Indian exports. But it's still, other than services, there's not a lot of exports from India. So there's a big future there, but I think it's going to have to continue to be sold.
Okay, Seth, so before we thank you, until we hear the end piece of this, which may be some time away, do you think financial markets would continue to drift downwards from where they are right now?
I don't think that it will be a long-term trend. I think there'll be a reaction to these tweets, a reaction to how it plays out with China. But I don't think this sort of problem is going to have a long-term effect on the markets. But I think what's more important mid to long term is just simply growth. And if global growth slows, yes, we're going to see some pressure on markets. On the other hand, we're seeing, record prices here in the U.S. stocks, and that does put pressure on emerging market stocks.
Okay, well, let's wait and watch if the pressure extends itself further. It's certainly showing on China. India is a lot more well-behaved right now. Seth, Freeman, thank you so much for taking the time out and accommodating this urgent request. Really appreciate it.
Thank you very much.
That's the view from Seth Freeman. Moving on to earnings, LIC Housing Finance's net profits grew nearly 17% in the March quarter. Disbursements too jumped about 18%. However, asset quality worsened a bit in the quarter gone by. Shefali Malik had a chat with Managing Director and CEO Vinay and began by asking about the factors that led to rise in disbursements. Listen in.
Q4 disbursement growth rate, overall growth rate has been 7%. The individual housing loan sector has shown a growth rate in excess of 18%.
Okay. So talk about your asset quality. There is some amount of an increase that has come in both your gross and net NPAs. Gross NPAs coming in at 1.53%, and even the gross NPAs in the individual segments have gone up on a sequential basis. Also tell us about how much have the gross NPAs been in the developer loan book?
Yeah. See, yes, the GNPAs have gone up to 1.53, 1.54%. What we have observed in this quarter particularly is that the accounts, all the accounts can be classified, put into three buckets. One is the standard one where everything is regular. The second is the delayed payment sort of a bucket. The third is the NPA bucket. This quarter, suddenly we find that there has been a 40 basis point shift from the delayed payment bucket to the NPA bucket. Project loans, in fact, the percentages have come down from 7.4% to 6.8% or so. The retail sector, of course, as you said, it has gone up to about 1.0. The net NPA has gone up to 1.04%. Mostly it is seen that this delayed payment sector, which the company is also experiencing for the first time such a big volume of shift from the delayed payment sector to the bucket to the NPA bucket.
So talk to us further about what's happening in the developer segments. What kind of developers are you lending to? Is it the mid segment or the large developers? Also, are you seeing a lot of increased demand because some of the other NBFCs, some of the other housing finance companies, some of your peers, they are deciding to go slow as far as the fresh disbursements are concerned. So what is the stance that you are taking, and do you see any sort of incremental stress coming in this particular segment?
See, first a comment on the share that the developer loan book has to the total portfolio. Last year we had a share of about 5%. The developer loan book had a share of about 5% in the total portfolio. Current year this share is 6.8%. We have disbursed about 7,200 crores to developers as against 4,200 crores last year. We give this loan as per our SOPs with due diligence on a case-to-case basis. Q3, Q4, I would not say that there has been a spurt in the proposals coming to us. They are around the same level as they were before. In fact, till September, October, our disbursements in this sector, the number of proposals that we did in this sector were fairly high. Q4 also, the company did a disbursement of about 2,000 crores in developer sector as against 2,200 crores which was done last year. The stress in the sector probably has not been noticed as far as our portfolio is concerned. The most of the loans that we have given are being regularly paid.
Sure. Sir, what about the retail book? From last 2 quarters at least, the the NPAs in the retail segment are also going up. So what is the reason for that? What kind of trends are you observing in that particular segment?
No, as I told you, this especially in this one, this quarter, whatever we were witnessing, whatever loans we were witnessing in the delayed payment segment, most of them, as I said, nearly 40 basis point shift is there from delayed payment to NPA sector, and this has primarily last 2 quarters the levels were around the same percent, 0.78, 0.8%, 0.889%. So, but this particular quarter, and we are very much concerned about it, and I'm sure that the coming quarter we have put the recovery machinery more on ensuring that we have the recovery, and I'm sure that by Q1 the position would be much better and improved.
Okay. Sir, talk about the margins. Your margins have inched up on a sequential basis. So where is that increase coming in from? Is it from the yield side, or have you been able to get a control over your cost of funding?
It's been both actually. The spreads have increased from 1.82 levels to 2.04 levels. The yield has also gone up as compared to last year. Now it is at 10.53% as against 10.12% last year. Cost of borrowing also, as compared to last year, it has gone up from 8.31% to 8.49%. But by and large, we have been able to pass on the borrowing height, whatever rate hike was there. Last year, for the full year, we increased our prime lending rate by about 70 basis points in 5 tranches, and that also has given us improved yield margins.
So, moving away slightly from the earnings, just a few additional questions I'd like to ask. What's your take on the developments in the sector? You think that the pain that housing finance companies and NBFCs on the whole have been witnessing, is that pain likely to continue for longer?
Going ahead, see, probably looking to the liquidity position, though if you compare it with the Q3, Q4 was better than that, and probably it will take some time for things to normalize, maybe another 2 or 3 quarters, whereby things can considerably improve. So this is one part of the liquidity. As far as the demand goes, the demand of late for the last, not immediate, but last 1.5, 2 years, has shifted to the end users buying and buying of completed projects. So that probably is the reason why the growth rates have not been very terrific as far as disbursements have gone in. So that will continue for some time, and probably much of the growth rates that we have got, the sector is getting, is from Tier 2, Tier 3 cities. So that probably will continue, and maybe we get more higher growth rates from these Tier 2, Tier 3 cities.
So, sir, in next couple of months or quarters, do you think that the face of the entire sector is likely to go through a lot of changes? We've already seen Indiabulls Housing Finance go in for the merger route, at least that's what they're trying to, and get a banking license. So you think that a lot of M&A activity will take place in the sector, and also are you open to some sort of consolidation taking over some of the smaller housing finance companies?
M&As may happen. I mean, things are not that good for smaller companies. We, as such, are not looking for acquiring any company, but then, yes, maybe purchasing their part of their portfolio, provided the rates are good. That is a process which happens continuously, and though we have not purchased any portfolio in the last 2-3 years, but we are open to it. That evaluation goes on. It's a continuous process. But we are not looking forward to acquiring any or get any small company.
So, sir, for FY20, what kind of growth rates are you targeting, and also how much fundraising would you need to do over the next couple of months?
We are targeting growth rates for disbursement in excess of about 15%. The target for growth rate for the portfolio would be again in excess of 15, 16, 17%. Couple of months looking to whatever commitments, liability commitments we have, depending on that, as also the disbursements that we are looking on. Next maybe 2 months, fundraise would be say around about 20,000 crores or so.
All right, that is the management of LIC Housing. Now let's get in another management to talk about the earnings. NIIT Tech has posted a flat revenue growth for the March quarter. Margins have declined in line with the industry-wide cost increases. To help us decode the numbers in greater detail, joining us now on the show is the CEO, Mr. Sudhir Singh. Agam Vakil from our research team also joins in to take this conversation over. Agam.
Thanks, Devina, and thanks, Sudhir, for joining us and taking us through the numbers. But let's start by talking about growth. And it's been a strong annual growth, but sequentially, there's been a few challenges when it comes to revenue growth. Can you tell us a little more about why this is happening? What are the factors that you're attributing to this?
You're right. This has been possibly the, if not one of the most successful years for us as an organization. We've grown we've actually grown exactly 22.9% in reported terms and 17.6% in constant currency organic terms. This quarter, to the point that you made, we've grown in constant currency terms 1.3% quarter over quarter. Now, this is traditionally the quarter in which the GIS business, which is the business that, as you would know, we've divested at the end of this quarter. Quarter 4 used to be the quarter in which the GIS business used to do extremely well and show a jump. But this business, the GIS business that we've divested now, is a business that actually declined 15% in quarter 4 over quarter 3, largely because elections in India were announced, and that put in place restrictions on government spending. That's why quarter 4, this quarter, you see growth as being somewhat muted, though as you would have seen as a year, it's been an absolutely outstanding year for us in performance terms.
Right. So, very recently we had earnings from Cognizant, and what we saw was not only weakness, but also them, notching down their expectations when it comes to, their outlook go ahead, especially from the financial services sector. I know that a lot of these challenges were very specific to Cognizant. My question then is, what is your outlook when it comes to this specific vertical, and what can we expect going forward for NIIT Technology specifically?
So, Agam, we operate essentially across 3 verticals, and even those verticals we tend to be very deep and very intensive when it comes to sub-verticals within those verticals. For us, the BFSI segment is largely a play around the buy side of the capital markets. Insurance, we tend to spread across PNC, specialty, and LNA. And travel, we tend to focus more on airlines and airports. At this point in time, we believe that the fundamentals of the business, from an internal perspective to the point that you made, are strong. And we continue to believe that what we've shared with the market in the past around growth being robust, growth being predictable, and growth being profitable as well along the margin axis is something that we will continue to chug along with.
Fair enough. If you can also tell us a little more about the deal wins that we've seen over the previous couple of quarters and the kind of impact they can have on revenue growth as we move into the new financial year.
So we've signed 4 large deals, Agam, over the last 2 quarters. This quarter, quarter 4 that we closed, we signed 2, and we signed an equal number in the previous quarter. Our order intake numbers, and we talked about this, over the last 4 quarters have now touched $646 million, which is about 27% higher than the order intake number for last year. Order executable stands at $390 million this year, which is about 15% higher than the number that we saw at the end of the same quarter last year. Now, as a firm, we do not give guidance, but as we've said in the past, the core fundamentals of the business are strong, and the robust growth, the predictable growth, the profitable growth, which is the mantra that we've been trying to drive over the last 8 quarters specifically, is the course that we'd like to continue to be on.
Okay, the other aspect as far as the industry is concerned, Sudhir, is that a lot, and through the conversation with a lot of your peers too, what is emerging is the fact that there has been a talent crunch, which is leading to rising people's costs. My question to you is, what is your observation in this case, and has that had any impact when it comes to margins for NIIT Technologies?
So, Agam, I think it's a reality that there is a fight for talent, in some ways a war for talent that one keeps reading about and talking about all the time. If you look at us, we have very successfully in the last 4 quarters managed to increase our workforce by significantly north of 10%. Now, getting back to your immediate question, is there a crunch for talent? The answer is yes, but I think we've been able to manage the ask in terms of onboarding people and in terms of reskilling people, largely because of our legacy as a firm that started off more in the training and education space and the training engine that we have, and B, by doing, we believe, what we think has been an outstanding job in terms of maintaining the operational rigor around hiring, training, and running delivery operations. So as we've said in the past, the margin numbers that we've secured, and our margin numbers for mid-tiers are best in class, are numbers that we think we should be able to maintain.
Sure, Sudhir. I'm sure there'll be a lot of curiosity when it comes to bearings, considering there has been a change at the top. Of course, these are early days, but if you could give us any indications from bearings whether or not there could be a change in strategy going ahead.
Not at this time, Agam. All the conversations that I've had and we've had as a group with the bearings team leads us to believe that they continue to be committed to driving value for the organization by helping us and working along with the management team, and they've talked about this, to ensure that we continue to drive growth, profitable growth. So at this point in time, every signal we picked up is that they are happy with the strategy that we pursued, with the tactics that we pursued, and of course we're looking forward to working with them, getting guidance from them on any changes that they might consider. At this stage, we are not aware of any.
Fair enough, Sudhir. We'll leave it at that. Thank you so much for joining us and taking us through what we can expect from NIIT Technologies in the future. And on that note, it's a wrap on today's edition of Indian Open. But don't go anywhere. Up next is the F&O show. Stay tuned in.